You are now live.
We are now live. All right. So, committee, we've only got one bill to do today. And that is H515. And that is an act relating to banking, insurance, and securities. And Maria, I got you first, but if the other witnesses think it might work better, have you guys talked about what might work best for you?
We talked about it a little bit, but I'm happy to defer to the commissioner if he would like to make some introductory remarks, or we could just start going through the bill. I could provide a broad overview, or we can start going through page by page. It is only one bill, but it's about 98 pages long. However, a lot of it is kind of model based laws that are required for accreditation. They get a little weedy, but I'm not sure you're going to want to get into the weeds.
This is usually kind of housekeeping. The only time I think we departed was the sandbox, which got a little interesting. But
You get an update on the sandbox?
we could ask for an update on the sandbox. Has anybody applied for that?
So, yeah, so Chair Cummings, Mike Pichak, Commissioner, Department of Financial Regulation. We just, if I remember correctly, last year got an extension for the sandbox for another 2 years because during COVID, the sandbox passed and was implemented, if I remember correctly, right before COVID, and anything that involved new products and innovation and risk that was beyond what was already known to a company sort of evaporated. So I don't believe we've had any, I know we haven't had any applications. I don't believe we've had any outreach even about, about the possibility of filing an application at this point.
Okay. So
I did just have a conversation with a few fellow commissioners, and I said, the one thing I did think the sandbox was useful for is this frequent, I guess it was a criticism, not of Vermont, but just generally of insurance laws saying, insurance laws are from 1850. They're preventing us from innovating and doing business. And I do think the sandbox allows us, or would allow any regulator to say, well, tell us exactly what it is that's preventing you from doing business and innovating. And, so maybe that's a sign that, maybe that was more hyperbole than actual restrictions preventing innovation.
okay. All right. So Maria, Commissioner, do you want to make some opening remarks? I kind of threw you a curve there.
Yeah, sure. No, sure. Happy to. Just, thank you very much to the committee for taking the testimony today. Thank you very much for Maria for all of her work on our bill this year. As always, it's in excellent shape. Thanks in large part to her. Also with me is our Deputy Commissioner of Captive Insurance, Dave Provost, our Deputy Commissioner of Insurance, Kevin Gaffney, and also our Director of Policy, Emily Kosicki. So I think everyone in this committee knows that Jill Rickard, who was our Director of Policy, is now working for ACLI after five years at the department. So Emily Kosicki has been with the department about, I think, 7 or 8 years, and previously worked as our legislative liaison before Jill was hired. So we're really fortunate and excited to have Emily in that role, and thank her also for her work in getting the bill to where it is now. So, as Maria said, I'll just, I sort of tried to summarize the contents of the 90 plus pages as concisely as I could. And, at the beginning, there's a handful of technical corrections. It's not a technical correction, and it's sort of a relatively, I would consider it a relatively minor expansion of our ATM notice filing requirements that would expand to crypto kiosks. And then there are 6 model laws, as Maria mentioned, 5 of them from the NAIC, 1 of them from NASA, the North American Securities Administrators Association. The 5 models All of them we follow pretty closely, with the only exception being the cybersecurity model that we're proposing. And the only reason we don't follow it completely is that we are not following the notice provisions contained in the model, because Vermont has had a much longer history of these kind of notice filings, and we think it's more robust and a stronger regime than what was proposed in the model. But otherwise, the models that we're proposing follow the ones that were passed by those associations. And then there's also the captive insurance provision. So the captive insurance bill is part of this department bill. There's not a separate standalone department bill. And we'll ask Dave Provost to present on those provisions when the time is appropriate. So I think that's the overview. I'll turn it back over to Maria to take it away.
Okay, Maria.
Okay, great. So some of you have hard copies in the room, and also what's posted online are two documents under my name, and one is the bill as passed the House, which I will be going through on a section by section basis. But then I also wanted to just provide you with a summary that looks kind of like this and just describes each of the kind of components or sections of the bill, and has page numbers generally just for your reference in case you want to jump around a little bit, because like I said, it is a pretty long bill. So with that, I'm looking at page 1 of H515 as passed the House. And as the commissioner noted, the first 6 sections of the bill are all very technical amendments. We'll go through each one very quickly. Although they represent 1/4 of the sections of the bill, they're only 3 pages of the bill itself. But that being said, the first one, section 1 on page 1, this essentially just strikes, you'll see the reference to guarantees. This is under the insurance holding company system law, and it strikes the reference to guarantees in this particular subdivision because guarantees are addressed in another section of the law. So no substantive change. Sections 2 and 3 amend the Vermont Securities Act and specifically clarifies that filing and registration fees are non-refundable. This is consistent with current departmental practice. So again, no substantive change there. Section 4 applies to, and that brings us to page 2 of the bill if you're following along, applies to Vermont financial institutions and basically gives the commissioner explicit authority to revoke a bank's charter if the bank ceases to exist or ceases to be eligible for a charter. Section 5, also on page 2, you'll see that it's just really an update of federal regulatory entities. You'll see Office of Thrift Supervision is stricken because it no longer exists. And then the relevant federal entities are referenced the FDIC, the Consumer Financial Protection Bureau, or any other federal regulator. So updating Vermont statutes. And then finally in section 6, which is on the bottom of page 2, you'll just notice there's an updated cross-reference. So a technical correction there. So that brings us to the first substantive provision, and that's on page 3 of the bill. This is the section that the commissioner referenced that basically expands the registration requirements that currently apply to ATMs to now also apply to what are called virtual currency kiosks. And those are basically like an ATM, but allows a consumer to purchase digital currency or sell digital currency. And they're often found like ATMs in convenience stores or other places. The requirement here would be that every kiosk in Vermont be registered. And the department can speak more to this, but this is just an opportunity for the department to become more aware how many there are in the state and where they're located. There is not currently proposed here any kind of a fee attached to the registration. But again, trying to monitor their use and their locations in Vermont. And so please, Madam Chair, if it's helpful as we go through, if you have questions and you want to understand a little bit more of the policy as we're going through them now, by all means, you can stop me and ask questions, and the members of the department might be able to help answer. Or if you want to hold questions till the end, whatever works best.
I'm not seeing any questions, so
Okay.
far, so good.
Okay, great. So that brings us to section 8, which is starts on the bottom of page 3. And this is in the insurance trade practices chapter. These are specific requirements that govern insurance companies. Most of them are consumer protection type provisions. And under current law, insurance companies are generally prohibited from offering rebates as an inducement to the purchase of insurance. And what this proposal here in section 8 would allow insurance companies, group insurance companies, to offer rebates to consumers if they are considered value-added products and services. So that means things that directly relate to the insurance coverage. For example, if it's health-related insurance, it might be something related to activities or programs or things that might enhance a consumer's health or well-being, financial literacy, things that would improve the consumer's exposure to risk. So in that way, benefit both the consumer and the insurance company.
Okay, so right now, they can't say, I'll get a $10 rebate if I sign up by a certain date. But they can say if under this, they can say if I sign up by a certain date, they will pay for a gym membership, if it's health insurance, they might, okay, that they would give, rather than a financial, they would give me something that would add value to the product, not just a check back or a lower rate.
That's right. So actually, if you look on page 4 of the bill, you'll see a list starting with Roman numeral 1 of all of the criteria. And I'm going to get down under Roman numeral 2. So in addition to the product or service relates to the insurance coverage, it is primarily designed to satisfy one or more of the following: provide loss mitigation or loss control, reduce claim costs or claim settlement costs, provide education about liability risks, monitor or assess risk, identify sources of risk. I'm just kind of jumping through. Enhance health, enhance financial wellness. So as you can see, it's a pretty expansive list, but they all have in common that they relate to the insurance coverage, and they're all for the benefit of both the consumer and the insurance company.
You can't give me a free toaster.
Not unless you're in the toaster business or something along those lines.
Okay.
The toaster had a smoke detector, you know, or some sort of risk controlling.
Well, I would say fire, yeah, if you wanted to give me a smoke detector for homeowners insurance, I would say driveway plowing services, reduced liability. All right, we could stretch that a bit.
So then that.
Do you have a question?
We did this with doctors, didn't we? For having people come by and give them gifts to try to get them to. This isn't trying to influence the seller, this is trying to influence the buyer.
This is, ask the witnesses. I don't know that they can hear you.
Sorry, I did not hear the question.
I'm just, it makes me squeamish, so, but I don't know what to ask, so I'll just sit here squeamishly. Okay.
Well, Senator, just to hopefully make you less squeamish, I mean, the concept here is really talking about, innovations that are happening in insurance. So, we were joking about the smoke detector and the toaster, but it's quite literally those type of items, a smoke detector, something that would detect flooding in your basement if you had a water heater break. That little device that they would provide you might be $50. And it's of a tremendous benefit to the insurer to notice that your water heater is overflowing immediately, and a tremendous benefit to the policyholder too. But under current law, that might be considered a rebate and not something the insurer could provide. So that's the type of.
I failed to connect the gift to the reduced likelihood of.
Exactly, it's got to be connected.
Claim, and I withdraw my squeamishness. Thank you.
Okay,
Okay,
we're on a roll. Keep going.
excellent. Section 9, page 6 of the bill. So this will be familiar, I think, to some of you. A few years ago, you looked at an NAIC proposal to reduce the minimum statutory interest rate that's applicable to the standard non-forfeiture law for individual deferred annuities. That's a mouthful.
Where I'm on, did you say page 6?
Page 6, section
Oh, okay.
9.
That's just one, all right.
It's a very short.
Parentheses and numbers, yes.
Yep, you see some numbers. So
Okay.
in a nutshell, so this would apply to if there's a lapse in payments. So somebody purchases a deferred annuity, they don't make the regular payments. At some point, they're entitled to get back their kind of cash value of whatever they've paid so far, the surrender value. Under statute, there are a number of conditions, but one of them is you get a minimum interest rate applied to that value. And under current law, it's 1%. There was a proposal to amend the model law, the NAIC model law, to reduce that minimum amount to only 0.15% of the value. You looked at this 2 or 3 years ago and considered it, and were not sure, and asked the department to further study the issue and report back with a recommendation, which the department did this year. And the recommendation was to basically follow the NAIC's lead and reduce the interest rate as proposed here. So with that, if you want to hear more about the report or the study, then the department can answer questions there.
I think it might be helpful to hear the thought that went behind this. This is annuities, right? So I have an annuity, I have a paid-in value. And if I stop paying in, then eventually I get to reclaim what I've put in there, like as in savings. And this is the interest rate that the annuity company would pay me for the time it sat since I last paid. Or put it.
Yeah, that's exactly right, Madam Chair. And the two things for me that were determinative, and Kevin or Deputy Commissioner Gaffney can go into more detail, but one was that interest rates have been, historically low, and they can be as low on treasuries and things that they would invest in as 0.15. So it's not, I think it's matching the reality of what was a low interest rate environment, though it's sticking up. But the other thing that was determinative to me is that this would apply to new products, new annuities that are sold. It doesn't, if you've had an annuity that you've been paying in for 10 years and you pay in for another 5 years, and then you are unable to pay and you are getting the cash surrender value of that annuity, you would have the old the old interest rate would apply to you under that product that you entered into before this statutory change.
Okay.
So for me, those were the two determinative reasons for us to agree with this. This wasn't something that was a proposal by DFR, it was something that was a proposal by industry. But once we got comfortable with it, they asked for it to be included in our bill, and we said we would agree to do that.
Madam Chair, can I ask a question?
I got Senator Hardy and then Senator Starkin.
Commissioner, can you send us the report, or we might have it somewhere?
Oh, yeah.
You send it again, just so I can read and maybe understand it a little bit more.
Yeah, of course. I will do that. I think Emily might have had to jump off. I'll do that while we're
Yeah,
I'll do it
if you send anything to Faith,
Oh, thank you.
if you've already sent it, it's probably posted, but. Okay, so this would only be the new, if I started a new annuity tomorrow, or the day after this would go in, this would be the interest rate, but any existing annuity is still going to get paid under the old rate.
Yeah, and it's the minimum, right? It's not the interest rate that would apply, but it would be the minimum amount.
That's the minimum rate. Okay, so rates on bonds have gone down this low, so this is just setting a new floor.
Yeah,
What we've been seeing.
there was a period of time where, the minimum was 1%, but what the companies were actually earning, in some of the fixed income investments were under 1%. So they're making the argument that the floor should be sort of relatively consistent with what they can actually get in terms of a return on those fixed assets.
Okay. Okay, Senator Sarakin.
Thank you, Madam Chair. So I'm trying, Commissioner, I'm trying to understand, does the minimum reflect what the annuities will pay, or can they pay whatever they want in a competitive product?
Yeah, so I'm going to ask Commissioner or Deputy Commissioner Gaffney if he can provide more detail, but I think it's sort of would be determined by sort of the market forces that would determine that interest rate.
Yeah, thank you, Commissioner. For the record, Kevin Gaffney, Deputy Commissioner of Insurance. Yeah, some of the impetus for this. Remember, this is the conservative annuity market. It's the fixed annuity market, and like if we are entering into an inflationary cycle that may arguably maybe are beginning to, the floor is not going to come into play. It's just when you had 2 decades of a floor that was really artificial relative to what the market conditions were. The concern was that there's still a need for this type of product in the marketplace. And if you had that ongoing frictional cost, it's going to either dry up the availability of those products, or the competition in terms of the interest rate that you actually will earn, the 3-4%, whatever the marketplace may offer, could be affected by this. So it doesn't impact the ability to earn an interest rate, but it is based on the marketplace. So what was felt by just bringing a sense of reality to what can happen in low interest rate environments is that we're now preserving the availability of this market, one, and the competition within the market, which is going to drive up the inducement of higher interest rate available, higher fixed interest rates.
I sort of remember having this conversation in this committee before, and I guess I'm not understanding why we wouldn't have a variable floor. If you think the minimum is too high right now, I assume the minimum rate is there for the protection of the consumer, that a company will pay at least something, but that minimum right now has been too high. But if we lower it, then there's nothing to stop the company other than competition, I guess, from giving that really low rate, even when we may go up to 7% interest rate. I mean, we have interest rates in statutes like the usury rate is like, or judgment rate is like set 12% or something like that. And when interest rates are low, there's pressures to lower that. But then there's times when interest rates have gone up to like 17%. And so it's, you know, I'm just wondering whether we change it every time we have a situation like this, or we have some sort of connection, what is it called, where you look at some other rate, and for that year, it can't be more than a certain percentage above that rate, or a certain percentage below that rate if you're dealing with a minimum. Is it not true that this minimum rate was established to protect the consumers?
It was, but it was established at a time when interest rates were, this was in the early 2000s. And
Right.
we were coming out of a time when no one could anticipate a multi-decade low interest rate environment. So it doesn't impede the ability to earn. If the competing market, let's say, is a CD at a bank, right? The marketplace isn't going to attract those consumers if CDs are paying 5% by offering 3%. So the competition in the market is going to drive that. This is just making sure that when the low interest rate environment exists, that there's not this frictional cost that do dry up the availability of this fixed income market. There's a lot more protections in an annuity product than there are in some other products. And there's other ability to offer other benefits within an annuity that you wouldn't have within other types of fixed savings.
I mean, it sounds like the timing of this is a little bit off, given that we're going into higher interest rates. And it also sounds to me like you're making the argument that we shouldn't have any minimum.
Kevin, this is not the interest rate that I'm making on my annuity. That
No.
reflects, this is if I stop paying. Okay, so I cease to pay for my annuity. And eventually I can take my money out of that annuity, the base that I've put in. This is the interest rate that will be paid on that base, and that base is the money that I've earned in the past, right? Not just what but the 7% I made for 10 years. And so that's my base, and the time, this is the interest rate that they would pay me between the time I ceased to pay the bill and the time I actually drew the money out. Is that,
Well,
it's not the overall return on that investment. I think.
Yeah, if you maintain the annuity, if you're in the accumulation phase when you say you're putting money in, and now you enter the distribution phase. But at any point in time, you have the ability to just forfeit that contract and get a value. So this value is calculated at that floor when the floor is relevant. When we're into a high interest rate environment, the earnings on these are going to be well above that floor.
Okay. Senator Hardy, do you have a?
Yeah, this is, we're belaboring this, but Senator Sorokin, I think, is making a good point that if we benchmarked it or whatever, it's tying it to something so that it could go up and down depending on interest rates, then we could just leave it and it would take care of itself instead of setting a floor that's too low for a time when interest rates are getting higher or too high from when they're getting lower. It's just pegging it to something. And I'm wondering, do you consider that as an option? Okay.
Yeah, I'm not sure what we're pegging it to, but I think the mechanism here, when you're talking about a fixed income product, is you want to have some certainty. You want to have certainty for the consumer to be able to purchase a product that can offer a level of fixed return. and you want to have certainty in the delivery of that product and the cost of that product. So I think this does both of those things. And I think if you look at we did a fairly detailed report on this that should be posted. That might just give you some, I think there's even some illustrative charts in there just showing you kind of historical interest rates and how this would function. So this is a model that I think we feel makes sense. We want to make sure that consumers that are looking for safety have a good, strong, competitive market. I think the floor is really something that often doesn't even come into play because most annuitants save for their annuity and then they receive those monthly payments or however they want to do them. This is just to preserve a marketplace. If we don't have a vibrant marketplace, then the real cost is just that we don't have enough competitors in the market, and that the product and the competitive design of the product is lacking.
Kevin, I've red flagged this, and I think what we'll do is we will do annuities 101, because I think we need to just understand how they work and where this interest rate plugs in. And I think that might be easier, and I'll leave it up to you and Maria. If there's somebody that can do this in very basic English.
Yeah, and the report we did, Madam Chair, it does basically set the foundation for that. So it wasn't just to report on the specific ask, but to kind of step back, because that was what I had asked our staff person, and Mary Block in the insurance division did some great work on this. She has a lot of background in this area. So there's a lot of basically annuity 101 in the beginnings of that report that do set the foundation. So happy to revisit any of those.
Well, we will ask her to come in before we make this. This is one line. We've just been through 6 pages.
I do think it would be good to have Mary or somebody from the department run through the report in detail, just so that all your questions can be answered and you feel comfortable with this. And I think, I think the reason we landed at where we did was not, that's part of the model. If I understand, the NAIC model is at 0.15. So I don't know if we considered attaching it to, the LIBOR or the equivalent sort of variable interest rate, but part of the motivation here was to move toward consistency with the other states within the NAIC model approach.
Okay. So Maria, let's move on. Travel insurance, that sound pretty good.
Yes. So starting on page 6, section 10, this establishes or creates a new chapter in Title 8 that pertains specifically to travel insurance. So it's a whole new regulatory scheme that applies to travel insurance and deals very specifically with the regulatory licensure sales practices specific to just that line of business. So you can see that that's basically stated in statutory section 7122, scope and purpose. And I'll just read the purpose. In subsection A on page 6, the purpose of this chapter is to promote the public welfare by creating a comprehensive legal framework within which travel insurance may be sold in Vermont. So then we'll go through and we'll touch on kind of all of the substantive provisions, and just let me know if you want me to go slower or faster. But I'll just note that on page 7 is the beginning of the definitions section. And I think most of them are pretty self-explanatory, so we can refer back to them if need be. But for now, if we just want to jump over, not read through all of the definitions, that would then bring us to the first substantive provision, which is on page 13. And so at the bottom, bottom
Can
half.
I just-
Alexander Pearson.
Maria, this is just new, is that right? We don't have this in statutes?
That's right. So they would, under current law, they have to comply with, insurance trade practices, consumer protections that apply generally to insurance companies. This is much more specific to a specific line of insurance. And so it has provisions not only related to their licensure and registration, but for example, travel agencies, how, what information they are required to provide to consumers who might be looking at purchasing travel insurance, making sure that they are able to contact the insurance company and understand all of the details. So it is very specific to just this particular segment of the industry.
Gotcha. Then for my curiosity, on the bottom of page 6, there's struck through language in the new language. How does that work?
No, thank you. I noted that too. And I think that is technical enough that Secretary Bloomer will fix that and not
Okay.
require an amendment. But if you do propose any amendments to the bill, then I can fix it there.
Okay, no problem. Sorry, thanks.
Yep. No. There's always something like that. So good catch. So getting to the substance, if you turn to page 13, here you'll just see the licensing and registration requirements. There are no, in terms of any fees, any particular, licensing fees are consistent with what would already be required. So there's no change in revenue impact on the state. I'm just kind of trying to figure out how to summarize without taking up too much of your time. But significantly, if you turn to page 14, this gets to the disclosure requirements that are required to potential purchasers of travel insurance. So I'm now looking under subdivision B1, A through D. So you have to provide a description of the material terms of the actual material terms of the insurance coverage at the time of purchase, a description for filing a claim, the process for filing a claim, a description of the review and cancellation process. And again, I think I said this at the beginning, but if I forgot to say it again, this is modeled after an NAIC, National Association of Insurance Commissioners model law. So a lot of this language has been vetted through that entity. And I believe this tracks those provisions very closely. There are requirements that I'm now looking at the bottom of page 14, that the travel insurance producer, and the travel insurance producer is someone that sells insurance products on behalf of an insurance company. It can be an agent or broker, that they maintain a registry detailing all of the travel insurance that is offered and sold in the state, which gets to the ability of the commissioner to monitor the industry. I'm now looking at page 15. The producer, the subdivision 3, the limited lines travel insurance producer has to have an employee that serves as what is referenced throughout as the DRLP, the designated responsible licensed producer. And that is basically like a compliance officer specific to this business. You'll see in subdivision 5, that's the reference to the licensing fees, and it cross-references section 4800 of this title, so similar fees as already would be required for these brokers and agents. Then it has programs or requirements related to instruction and training on the offering of this type of insurance. Page 16, subsection C, any travel retailer. This is the information that they're required to provide to travelers or purchasers, written materials that they have. And they also have to provide the consumer the identity and contact information of the insurer to ensure that they can get in touch and understand more completely what the terms are of the insurance policy. Let's see. And a lot of this is really disclosure requirements for the benefit of the consumer and making sure that those who are offering the product understand what is being offered and that the consumer and the insurance company can contact each other in the event that there are any misunderstandings or disagreements. So then on page 18, this is the premium tax section. And again, this is all insurance companies in Vermont currently pay an insurance premium tax. You'll see in subsection A a reference to Title 32, Section 8551. This is the current premium tax that applies to all insurers in Vermont. And so it would remain the same for this line of insurance as well. So again, no revenue impact on the state with respect to this business. And then on page 19, statutory section 7126. This just generally pertains to travel protection plans. So this could be insurance. These could be terms that are related to cancellation fees or the waiver of cancellation fees. And basically, again, additional disclosure requirements that are made to the consumer. Also has sales practices that would apply to anybody who's offering a travel protection plan. More detailed sales practices are listed on page 20 under statutory section 7127. Specifically, you'll see in subsection B that the person who's offering or selling the policy has to comply with existing law that governs unfair trade practices. If there's any conflict between this chapter and that chapter, this new language would control to the extent it is more specific to the industry. Page 21, you'll see in subdivision 3A, this is very detailed procedures outlining the process for filing a claim. You'll see more specifically the second sentence under subdivision 3A, unless the insured has either started a covered trip or filed a claim under the travel insurance coverage, a policy holder or certificate holder may cancel a policy or certificate for a full refund of the travel protection plan price from the date of purchase of a travel protection plan until at least 15 days following the date that you received the plan and the fulfillment materials, or 10 days following the date of delivery from the date that they were mailed, other than through the US mail. Sorry, I just botched that up. But anyway, this is the period of time where a consumer can ask for a refund after purchase.
I didn't take the trip.
What's that?
I didn't take the trip, so I don't need the insurance, so I'd like a refund.
Right, or you've changed your mind, et
Yeah.
cetera.
Okay.
So there, yep. go
I
ahead.
got a question, Senator Hardy.
Well, are these things, maybe little I covers it, but are these things mailed anymore? I mean, insurance, aren't they just emailed?
I would imagine that they're mostly emailed, but I don't know that that's always the case. So this does cover if they're the 15 days, if they're sent by United States Post Office. So I don't know what the general practice is.
Yeah. But if you go on the trip, you can't cancel it like halfway through your trip.
Right.
Yeah, okay.
Right. So these time periods are from the date of purchase, but assuming that you don't purchase it, within 3 days before your trip and take the trip.
Yeah, okay.
Okay.
So then on page 23, the statutory section 7128 pertains to travel administrators. So these would be not necessarily insurance agents or brokers, but individuals, although they could be, or an employee of an insurance company that handles basically the claims, the payment of any premium that is due, the paperwork related to the filing of a claim or a refund, and so requirements for maintaining all books and records that are available to the commissioner upon request for examination. And then on page 24, with respect to the policy, this type of insurance, travel insurance, is classified or shall be classified and filed for purposes of rates and forms under an inland marine line of insurance. And I actually don't know why that is. So the department might be able to answer that question. That was actually, I have a note that I was going to have a follow-up question with the department, and I just had not yet asked that. And you'll see, just jumping ahead for just a moment on this subject, on page 25, section 12, there is a new definition of an inclusion of inland marine insurance under Title 8. And so it means any insurance that is defined by statute, rule, or general custom as inland marine insurance.
Wait. You can't define something using itself as the definition. Isn't that a circular definition?
It is a little bit circular, but I think, yeah.
I don't know what that means. Inland marine insurance is inland marine insurance is basically what that says.
Well, if it's defined in statute as, so it would include travel insurance, right?
Okay, let's.
But I think the department could probably do a
You're
better
going in
job
circles.
explaining.
I think the first question I have, I've bought travel insurance. My kids have bought travel insurance. One of them had medevac insurance. How do we do it now, and how does this change it? Because I think we're getting just overwhelmed with all the technical detail. How is insurance regulated now, travel insurance, or is it not in Vermont? And then how is this different? And I don't know who wants to answer that one.
I'll start, but I'll turn it over to Kevin pretty quickly. Just wanted to mention that there are regulations in Vermont now that our department has promulgated relating to the regulation of travel insurance. This model and this statutory regime would certainly be a more robust oversight It would apply to things like marketing and sales of travel insurance policies. It would require more disclosure in terms of the policies and the contracts that are being provided as well. And I believe, Kevin, also, even just the concept of the registration for the individual selling it, particularly when it gets down to people that are not traditional insurance brokers, but selling, in the travel agency, selling, this specific type of product. That's a new sort of regulatory regime, if you will, with a light touch and an appropriate touch in terms of making sure they follow Vermont laws and consumer protections, which wouldn't be the case now, but it's not a full-blown insurance broker because they're not selling other types of insurance. So I think, there are some regulations now. This would be a more comprehensive and robust set of regulations, but I'll turn it over to Deputy Commissioner Gaffney if he has anything else to add.
Yeah, thank you, Commissioner. Yeah, that's exactly it. We do have an existing, I think in 2016, we have a regulation that we do have several lines of insurance like credit and portable electronics and the like that have a licensure component. So there is a limited lines regulation here for those travel business entity limited lines for travel insurance. In that licensing requirement are some general provisions in there for dissemination and oversight, and the designated producer that's in this model is already in that regulation. So some of this is already established. What this does is really contemplate in more detail all the different ways that travel is disseminated, and what it specifically does is put oversight into those measures. And generally this follows the model. Vermont actually, sometimes when you lack any further detailed provisions in law, you have a general provision, and then you have kind of your practices in terms of how you review these products when they come to market. So we've had this discipline that we brought in advance of this model. So there's provisions in here that are even stronger than the NEIC model, like just having a materially similar insurance product provided. And this is typically done through electronic means. You're booking a trip, and then you have the option to purchase the insurance. Oftentimes that will actually move you to a different site. It won't really be the aggregator. It'll be the actual travel, the travel insurers site that you end up at. And that will give, now with this model, and I will say that this model is in many instances generally codifying current practice, but Vermont did add that we would want that the details of the insurance product to be available at the time of sale and not at some date post sale, because we felt that was a stronger level of consumer protection. So that's an example of what we added to this process, but it is generally just to provide more rigor, and now we can hold companies more accountable for their actions, because there's a much more detailed regime here if we pass this model.
Okay, so you do have travel insurance now, but this is a much more rigorous based on a national model. So that, yeah, I mean, you used to just put your dollar in the machine at the airport and you got something out and hoped you never had to read it. And now they are much more complex, especially when you get into medical issues. Okay, Senator Hardy.
Thanks, Madam Chair. Maria or Commissioner, my complaint about that definition still stands. It's just, it's confusing, and also inland marine itself is confusing. So Could you tell me what this is and if there's a way we could get a better definition in here?
Yeah, so, and I think, again, I'll turn it over to Deputy Commissioner Gaffney if there's more detail, but marine insurance generally is referring to products that are transported over water. So the insurance of various products that might be transported by cargo vessel, for example. Inland marine generally relates to the coverage of products that are transported over land, so train, plane, car, truck, or something of that nature. So I think when you file with these certain types of insurance, there are ways, there are certain expectations around what a policy or what a form might look like as it comes into the department. So I think this is saying you should file as an inland marine type product, which would put you in a certain type of format, and it would come to the department in a certain way with certain provisions included. I think I think you probably could pick different lines of insurance for this to qualify under. I'm guessing the inland marine has some to do with the fact that there's coverage often for the things that you're traveling with, and your laptop or your suitcase or your or anything that you're shipping with you. So I think that's why it's in this provision. That's what inland marine insurance generally means. But I don't know, Kevin, if there's anything else.
This is an existing category of insurance, like life insurance, health insurance, and you're just saying that travel insurance here comes under that existing category. It's not the circular, that this is it and this is what inland marine is. It's just under this umbrella type of insurance.
And it's a broad category of insurance. I think what the commissioner described is the large part of inland marine, but inland marine includes things like can include things like insuring your jewelry. It's things that just are items of value that can have exposure because they are perhaps related to your movements and travel. Not
is insuring your laptop for going over like the Great Lakes because they're bodies of water that are inland?
No.
I'm literally, I'm not trying to be facetious. I'm really confused.
So ocean, so it's almost, and the commissioner touched on this. You have to talk about ocean marine, and then so inland marine is not ocean marine. So ocean marine.
It's not the ocean, so it could be the Great Lakes.
It's generally cargo, so it's generally shipping, cargo, rail.
So marine is not referring to water, it's referring to anything that's not.
Yeah, ocean marine is. It's inland marine has nothing to do necessarily with water. It's just because it's inland marine, it's not ocean marine. So, and you don't have to be traveling with your laptop. You can actually just insure your laptop and not be traveling, and that's inland marine.
Oh my gosh.
You can actually have a piece of heavy commercial excavating equipment that is not registered, and that's inland marine. So inland marine is a very broad category of insurance. The overarching thing is it's property and casualty by being inland marine. And so as state regulators and through our kind of convention of reviewing forms, we have to put a type of insurance on a product, even if it doesn't have kind of the perfect fit. But inland marine is oftentimes where these things go. There's actually an other category, but we don't like to use that. We like to use inland marine if it's appropriate, and it is appropriate here for travel.
No, inland marine, outside marine, all has to do with moving things, right? I mean, if I just want to insure my computer, I can get insurance on my homeowners on my computer, or property casualty. But if my computer or my camera is going on a train, a plane, something, and I want to make sure that it gets there or I get reimbursed. So it's a much more limited thing, but it's for the duration. These are short term generally, right? I mean, they're for the duration of a trip. Maybe somebody sells lifetime travel insurance, but generally it's for a specific 10 days, 3 days. And that's, if something's moving in there somewhere.
Yeah,
Is that?
it doesn't have to be, Madam Chair. I know this is
I
weedy
thought I had
insurance
figured
stuff,
it out.
but you can have, what you described is correct. Like you could insure your computer on your homeowner's policy with just a basic homeowner coverage, usually has a dollar limit, usually has a deductible. But then you can get in the marine first dollar coverage, and it doesn't matter whether you're traveling or not. But so, you know, the good example is what happens with when are laptops often purchased? It's when maybe a student's going off to college. So that's the time when you make the decision. Do I want to still keep it on my homeowners with a lot more deductibles, or do I want to get in the marine coverage because they're traveling to college, but it's not the travel that the travel kind of puts it in the marine, but it just protects that item no matter where it is to a specific dollar amount. So you're insured to that specific value.
What if their student is going abroad? Is that still inland marine? Even though they're going
Yes.
over an ocean?
No, it doesn't matter about the ocean.
It doesn't matter, the ocean doesn't matter. The whole
They
marine
can-
word is totally messing with me.
They can take a plane, they can,
I'm gonna let it
With some
go.
history behind it. Going back to square root. Vikings probably. All right, I think we should go on to something much simpler, like captive insurance.
Okay,
Okay,
so starting on page 25, section 13, sections 13 through 19, all apply to captive insurance. So we'll just start at the beginning. Section 13. This basically has to do with reporting requirements that are applicable to premium tax reconciliation. So making sure that the captive is submitting the premium tax that is due to the state. So what this proposal does is simplifies those reporting requirements for captives that report on a fiscal year-end basis.
okay, simplifies the reporting requirements. For
Then,
captive.
yep.
I can probably get away with just saying that on the floor, right? Okay,
So section 14 at the bottom of page 25, this applies to delinquency proceedings against certain captive insurers. So this would be a proceeding for the purpose of liquidating or rehabilitating or reorganizing an insurance company in the event of an insolvency, for example. So under current law, those proceedings can be made against a sponsored captive insurance company, but not the individual protected cells. This proposal here would basically allow the proceeding to be brought against just a protected cell and not the entire sponsored captive insurance company. And that way the commissioner could deal with that protected cell that's insuring a specific risk without also impacting other cells that are not particularly related to that cell.
okay, I'm seeing a beehive, not an apartment building, but we got all kinds of little cells. And then there's the overall hive. And right now, there is a delinquency in one of those little cells. Somebody's a bad actor. You can't bring a delinquency proceeding against that particular cell you have to bring it against the entire beehive, which I'm assuming causes a lot of buzzing and swarming. This would allow you to target the actual bad actor. I got, okay, see, I'm getting good at this.
Excellent.
Okay, we need some fun on the floor anyway. All right, too many hours.
I'm gonna ask you about the definition of inland marine insurance.
It's a term of art, said with a perfectly straight face. Okay,
So then section 15 also has to do with protected cells in the beehive. And this basically allows a company to insure the risks of an unaffiliated participant, subject to the commissioner's approval. So you can expand your coverage to businesses that are not necessarily affiliated with your business.
okay, that's gonna take, I'm catching the squeamishness here. To unaffiliated companies. So I thought a captive in general is a company or a group of companies that have something in common. They form together to form a captive, reduce their risk because they spread it out. I'm looking at David and he happens to have center screen right now. This, refresh my memory, what is an unaffiliated company, and is this, I'm going to get asked, is this somehow breaking down the concept of captives just insuring their captive members? Are they
Right.
going outside the hive?
Got it. I was just muting myself while the sirens went by. For the record, David Provost, Deputy Commissioner of Captive Insurance. Thank you, Madam Chairman. Before I answer that, I would like to introduce Sandy Bigglestone, who is with us today. Sandy's been with the department for 25 years. She's my right hand. And for at least the past 15 years, Sandy's been a big part of the captive bill every year, especially when it comes to things where we are working on our accreditation with the NAIC. So although she might be new to the committee, she's certainly not new to this whole process or to DFR. So just want to make sure that everybody knew who Sandy was.
Well, thank you. I've met Sandy before, but I've been doing this for a while.
Got it. So to answer the question, we do allow some captives to insure third parties under what we call unaffiliated, controlled, unaffiliated business. So there has to be some connection, but might not be a company that is actually in the corporate organizational chart, but it would be somebody that they have a lot of control over in terms of the risk management and loss control and claims control. A very good example that we've often used was a supermarket chain that did not own a trucking company, but there was a trucking company whose sole business was shipping goods from that supermarket's warehouse to that supermarket's stores. So they had to follow all the rules of risk management dictated by that supermarket chain, because although they weren't owned by them, they were the only customer. So it was a very unique relationship. So those kind of relationships, it's appropriate to be able to offer coverage from your captive. That's also typically fronted, so it is actually coverage provided by an admitted licensed company, reinsured by the captive. And we have, for years, been trying to make cells be able to do the same things that captives can do. And so this is just one spot. And I believe there's other places in the captive cell law that allows this, and this one spot did not allow it. So it's not opening the door wide open. It is allowing that crack where suitable, again, with the commissioner's approval, to include other unrelated, technically unrelated companies on your insurance program.
Okay, but still with that, they have control over them in some form.
Exactly.
Okay, so how, if they're doing it now, how does this widen that what do we want broadening here?
This allows a cell to, regular captives can do this already.
This
allows
allows
it-
a cell to do what regular captives can do. Okay,
Exactly.
okay.
Are we ready to move on?
I think we're ready.
Okay, so sections 16 and 17, starting at the bottom of page 28. These are the reporting requirements that are specific to sponsored captive insurance companies and their protected cells. So section 16, you'll just see that stricken language. And the reason why it's stricken is because now in section 17, there's a whole new section that applies to the financial reporting requirements. So if you turn to page 30 of the bill, you'll see that language is identical in subdivision A1. Each sponsored captive insurance company shall annually file with the commissioner such financial reports as the commissioner requires, which shall include accounting statements detailing the financial experience of each protected cell. It then goes on to specify, and this is new language, that the sponsored captive maintain all of its books, records, and documents within the state, that they are available for inspection by the commissioner, that they are maintained in that original copies or original documents are kept in the state unless the commissioner approves that electronic copies can be stored and reproduced, but really just greater detail about where the records and documents are maintained and available for the commissioner to examine. Is there anything you wanted to add, Deputy Commissioner or Ms. Bigglestone, or is that pretty much?
That you got it.
Okay.
The reason we've left that language in there, that there is some archaic language in there, but we didn't want to recreate the wheel. If we ever get around to dealing with archaic records language, that'll be a broader project in general. But this was designed to make sure that cell companies, which are very often have out-of-state work done on them, that the records were fully accessible to us to make it doubly clear.
So that then, if there are no questions, brings us to section 18 on page 31. And basically this gives authority to captive insurance companies to accept or transfer risk by means of what is called a parametric contract. And you'll see that that term is defined at the bottom of page 31 as used in this subdivision. Parametric contract means a contract to make a payment upon the occurrence of one or more specified triggering events without proof of loss or obligation to indemnify. And specifically here, the term is not meant to refer to, or by definition is not an insurance contract. So I can explain that a little bit, but you might want Deputy Commissioner Provost to explain,
Yeah, this is,
why this is being proposed and what it's intended to cover.
I'd love to. This is something we were hoping to have a much larger scale project, but because of other regulations involved, we pared it down a lot. But a parametric contract is a contract based on an outside measurement. So for example, if you have an earthquake of a specified intensity within a specified distance of your factory, then the contract will pay. You don't have to prove you had a loss. if you had great loss prevention and everything was mitigated and you had no loss, you still get paid. And that's why it's not considered insurance. Under an insurance policy, you might have had the same earthquake. You have to prove a loss. You have to assess the building, see what the damages were. You have to fight with the insurance company a little bit, and then you'll eventually settle and you'll receive a payment from the insurance company. A parametric contract simply pays on the occurrence of the event, whether or not you have a loss. You kind of assume that you had a loss. If you're Walt Disney and you wanted to have a parametric contract to cover a hurricane that hit Orlando of a certain intensity, you can pretty well guarantee there's some damage, at least business interruption, because the roads to get to Disney are closed because of all the hurricane damage. So you might not even have damage specific to your property, but you have a loss because of the business interruption. So a parametric contract is meant to quickly pay. And that's what it's currently primarily used for. It will pay, you might have a huge property policy with a $2 million deductible. The parametric contract might cover that $2 million. You had the hurricane, here's $2 million, get to work while you're arguing with the insurance company. But because you don't have to settle, you don't have to prove a loss, the SEC considers it a swap, not an insurance contract. But it is becoming a very important risk management tool. And a lot of companies in the US like to put all of their risk management tools in their one basket that is their captive insurance company. So we wanted to make sure that, one, they had the express approval to do that. We believe they could do it already, but we want them to have the express approval to do that so that, one, a lot of our captive owners like to see that they're following the law. And two, a lot of the counterparties that would be issuing the parametric contract want to see that you can follow, that they're doing something within the law, especially since a great deal of the counterparties to these contracts will be the large global reinsurance companies anyhow. So they want to make sure that they're dealing with somebody that can execute one of these contracts. So we don't expect it to be huge, but this will grow over time to be a significant part of the captive insurance business. With proper terminology, it will be turned into insurance contracts. If you Google it on the NEIC's website, they will call it parametric insurance. So there's developing regulations and rules about this. It's a new product, but we just want to make sure that we are right out front, that our captives can enter these contracts safely within the law.
Senator Hardy.
Thank you, Mr. Provost. This is a definition that's actually a definition. I like that. Confusing. But so in these parametric contracts, do they have to define what the event is?
Yes.
Like it has to say if a hurricane happens, we would get paid or whatever. Okay.
Yeah, they are very specific. They will define what the peril is, hurricane or earthquake. You will define, what the intensity of the storm or the earthquake is. You will also define whose measurement are you going to use.
Oh,
so
okay.
for example, an earthquake, you would use the USGS quake monitoring. For a hurricane, you would use the NOAA's determination of a hurricane. And you may have more than one party doing that. So, okay, I've got USGS and I've also got the European earthquake sensors. So I've got more than one party saying, yes, you had an earthquake of X intensity, therefore that trigger has been met.
Okay, and then even though it's not an insurance policy, does the company pay a premium, or how does it work?
Yeah, it is you pay a set of an agreed upon amount, and it's typically these are like catastrophe bonds. You pay in. And there's a specified term. It may be 3 years. If you don't have an earthquake in 3 years, then you paid money for nothing. But if you do, then you get your money back and then some.
Got it. Okay. Thank you.
Okay. I think we can move on.
Okay, so section 19 at the top of page 32. This is a technical amendment in the captive statutes. You'll see that the phrase "or consolidation" is stricken, and that's because The statute only pertains to mergers. So then that concludes the captives proposals and brings us to section 20 on page 32. And this is the proposal that's based on an NAIC Model Act, which is specific to data security and insurance companies, more specifically. So it's the Vermont Insurance Data Security Law. Notably, and I think the commissioner, and we'll go through the substantive provisions, but as the commissioner mentioned in his introductory remarks, there is one segment of the model law that is not incorporated in here, and that relates to security breach notices, and that is because Vermont already has a Security Breach Notice Act that pertains to all data collectors generally. So those provisions would apply to insurance companies as they do now, and Vermont insurance companies would continue to report as those statutes require. So the NAIC model, as it pertains to breach notices, is not incorporated here. What is incorporated are the data security standards that insurance companies would have to follow, as well as the procedures and protocol for investigating a cybersecurity event or a data breach. So, just looking at the definitions, probably the one that is going to be of most interest to you is on page 33 of what constitutes a cybersecurity event. What are the standards designed to protect against? And what are the events that require an investigation in accordance with these provisions? So a cybersecurity event, this is in subdivision C3 of the definitions, means an event resulting in unauthorized access to or disruption or misuse of an information system or non-public information stored on such information system. The term cybersecurity event does not include the unauthorized acquisition or of encrypted non-public information if the encryption, and then I think there's one typo here. I believe it's supposed to be protective process as opposed to just process, or key is not also acquired, released, or used without authorization, or an event with regard to which the licensee has determined that the non-public information accessed by an unauthorized person has not been used or released and has been returned or destroyed. So if the non-public information is out there, but there's no means of getting through the encryption, or if the information is out there but it was not actually used or generally released to the public and has been returned or destroyed, then that would not constitute a cybersecurity event. But all other disclosures would fall under the definition. So, and again, this applies to just insurance companies. If you look on page 34, under the definition of licensee, it does not apply to, and I'm looking under subdivision 7A, a captive insurance company, a purchasing group or risk retention group, or a licensee domiciled in a jurisdiction other than Vermont, or a person acting as an assuming insurer for licensee domiciled in this state. So then just trying to think in terms of what what is considered non-public information for purposes of this chapter on page 35, definition 9. You'll see that could comprise business-related information, information concerning a consumer that because of name, number, personal mark, or other identifier can be used to identify such consumer in combination with any one or more of the following data elements: social security number, driver's license number, individual taxpayer identification number, passport number, military ID number, financial account number, security code, access code, or biometric record, which would could be fingerprints or DNA. Let's see. Again, just trying to be cognizant of the time and not get too far into details. But you'll see in terms of so every insurance company in Vermont needs to have on page 37 an information security program. So this is the program that would require the administrative, technical, physical safeguards for protecting non-public information. On page 38, the insurance company, the licensee, needs to designate somebody who's responsible. Yes.
Maria, one really specific question on the bottom of page 34. Why does it not include a captive insurance company? Do they have some different cybersecurity regulations? I see the deputy commissioner nodding, yes. Okay.
Yeah. Yes, captives typically have different rules, and in most of these cases, we are going to rely on the parent company of the captive to follow its own cybersecurity rules. Many of these companies are already regulated in other ways. A lot of our captive owners are hospitals, for example, so they have their own HIPAA rules to follow. So we are going to start with allowing companies to work with that, work with the parent company. We may eventually get to a point where we apply some parts of this to captives directly, but for now, we're going to rely on the parent companies.
Okay, and then a second question, Maria, you may have already said this. Thank you, Deputy Commissioner. Is this modeled after another state or federal or something? Did you say this?
Yeah, it's modeled after an NAIC model law, so the National Association of Insurance Commissioners. So a lot of Vermont's insurance laws are modeled for accreditation purposes.
Okay.
Yeah.
Okay, great. Thank you.
The one just additional piece of information I would include as it relates to the senator's first question, our banking divisions and our securities divisions also have separate requirements. That's why this is just specific to insurance. To your other point about what is this modeled after, Maria's absolutely right. It's the NAIC model, but New York State did move first in this space back in like 2017, I believe. They created a program similar to what the NAIC then based its model on. And for the NAIC, for the New York model, if you are operating in New York, even if you're not domiciled there, you have to be in compliance with their cybersecurity protocols. So most of our insurance companies that operate in Vermont and are domiciled here operate in New York as well. So this has been a priority for us, but not a top priority because they have already in many ways had to substantively comply with these requirements as it relates to New York. But this does give us the authority to do investigations, enforcement, examinations specific to cyber that we wouldn't necessarily have, although the substantive provisions, what the companies have to do will be the same. So it shouldn't be an extra burden to them, but it should be important. It should be an important resource for us as a department.
Okay, and that's why there's a cross-reference to New York State law then. Okay.
Yeah, exactly right.
Yeah, thank you. That's helpful.
Okay.
Okay, so just going back for a moment, page 38, in terms of the requirements that the licensee, the insurance company, has to comply with, having an employee or somebody that's responsible for the information security program. The licensee has to identify any foreseeable internal or external threats that could result in unauthorized access. I'm not going to read all of these word by word, but C, assess the likelihood and potential damage of any of those threats, the sufficiency of current policies or safeguards to manage those threats, employee training, management, and coming up with a means of detecting and preventing, responding to any intrusions on the system. Then in subdivision 4, based on looking at all of these potential threats or conducting this risk assessment, then the licensee shall design a security program that mitigates the identified risks and designs as appropriate security measures. And then you'll see listed on page 40 a number of controls that could be used based on the risks to the information. Let's see. There are requirements related to cybersecurity awareness training for personnel, and ensuring that if there's a board of directors, that they are informed of and have oversight of the information security program. They receive reports annually on the status of the information security program, et cetera. So just all manner of oversight and awareness of the safeguards that are in place. In terms of, let's see, on page 43, this gets more to the responding. If there is a cybersecurity event, I'm looking on subdivision 8A. There needs to be, first of all, a written incident response plan. And then in subdivision B, in terms of what's part of that response plan, the company needs to have a process for responding, the goals of the incident response plan, the definition of the roles and responsibilities of individuals responsible for that plan, documenting and reporting cybersecurity events. I'm on page 44. And then annually, each insurer has to submit to the commissioner a written statement certifying compliance with this section and maintaining all of the data to support their compliance, maintaining that for a period of 5 years. And then the more detailed steps for investigations are found in subsection E, which begins at the bottom of page 44. And it includes everything from determining whether a cybersecurity event has occurred, assess the nature and scope of the cybersecurity event, identifying any non-public information that may have been involved, perform or oversee reasonable measures to restore the security of the information, and then maintain all of the records concerning any cybersecurity event. The commissioner has the power to examine and investigate the affairs of any insurance company and any activity that might be in violation of this section, in addition to the commissioner's existing authority. On page 46, if the commissioner has reason to believe that a licensee has been or is engaged in conduct in this state that violates this section, the commissioner may take action that is necessary or appropriate to enforce the provisions of this section. And then subsection G, the confidentiality provisions are, and correct me if I'm wrong, Commissioner, but I think this is very similar to the other confidentiality provisions throughout Title VIII. So pretty boilerplate as far as the committee might be concerned, because you've seen this language, but just maintaining the confidentiality of information when the commissioner or the department can share that information with other regulatory bodies, et cetera. But I think that's pretty standard language in Vermont law already. And so then that would brings us to, after the confidentiality provisions on page 48, subsection H. These are the exceptions. So this describes licensees that are not subject to these requirements. So I'll just read subdivision 1. The following exceptions apply to this section. A licensee with fewer than 20 employees, including any independent contractors, is exempt from subsection D. And D is the section that I'm trying to talk as slow as I can so I can be having an information security program. Okay. So those small companies do not have to have an information security program. And the second exemption listed here is a licensee that has to comply with HIPAA. Then on page 49, this would be an exemption if you are already covered by a security program. So you don't have to have the information security program if you're already covered by those requirements, because you're an employee of another company that must comply with this section. Subdivision D, if you're a licensee that is affiliated with a financial institution, so these would be institutions that already have requirements that apply to them with respect to data security. So these could be banks or other financial institutions, non-insured financial institutions. Let's see, there is on page 50 a subsection on penalties if there's a violation of the requirements of this section. And then there's a specific effective date for this section only. This section takes effect January 1st, 2023. Okay.
Okay, any questions before we move on to financial services, education, and victim restitution special fund? Okay.
Okay, so sections 21 and 22. So these are amendments to an existing special fund, the one that the chair just read. And this fund, special fund, actually provides restitution for victims of securities fraud or securities violations. The fund also provides funding for financial literacy and education. So the proposal here, and this is also based on a model law, but not NAIC. It's a model law that was that has been proposed by the North American Securities Administrators Association, NASAA. So the body that regulates or proposes regulations on securities laws. So the proposal here is basically to expand the fund to also cover whistleblower awards. So if somebody works with the department to provide information about securities violations, and though that information leads to an enforcement action, then that whistleblower is eligible for an award by the commissioner, by the department, with monies that are in this existing fund. So the fund is renamed to the Vermont Financial Services Education, Victim Restitution, and Whistleblower Award Special Fund. So that's in section 21. It's just basically changing the name of the fund. In terms of the actual criteria that would apply to these awards, those are all contained in a new section of law, which is in section 22, statutory section 5617.
Okay, Maria.
Yep.
Who puts the money in this fund?
Correct me if I'm wrong, Commissioner, but I believe the money comes from enforcement actions from securities violations. So percentage of any judgment goes into this fund. And I'm not sure if there are other revenue sources.
No, that's right, Maria. That would be the exclusive revenue source. That's pretty much the exclusive revenue source of the fund now. So we just recently had a settlement with Robinhood that was a $640,000 settlement. $590,000 of that settlement's going to the general fund. $50,000 was carved out in the settlement to go to the victim restitution and education fund. And the concept behind that, whenever we enter into those settlements, is that there's some educational component that or program that we think would benefit if we issued a grant to, for example, in the Robinhood case, there's a lot of young investors that are working with Robinhood. They're being granted options trading accounts, margin trading accounts. It'd be useful to establish programs relating to financial literacy for those consumers. So that's how it works now for that fund. How it would work with the Whistleblower Protection Act. We would have a matter that was referred to us that we were not previously investigating. So this was a completely new matter that we wouldn't otherwise have known about. We decide to take action. We have a penalty that is reached. And then as part of that settlement or administrative action, we would carve out a piece of that penalty to go into the whistleblower fund that would then go and pay the whistleblower for referring the matter to our department.
Okay, and this is in the securities fraud only, right?
Yeah, yes, that's right.
All right, not just any whistleblower, all right. So it's a limited scope.
Yes, and it's based off of an SEC whistleblower program. That's why it's focused on securities. And it's been quite successful for the SEC. They've gotten referrals and tips for things that they wouldn't otherwise have investigated, based on, their representations. And it's resulted in a number of pretty significant settlements for them over the years.
Okay. I think we can keep moving, Maria.
Okay, and the only other thing I was remiss in not adding, in addition to the actual financial award for whistleblower, there's also this statute protects whistleblowers from retaliation. So there is that substantive component as well. Okay. And this is discretionary. All of the fund purposes are dependent upon there being money in the fund. And there are provisions relating to disqualification so that, anyway, so if you're an employee of the department, you wouldn't be eligible for an award, et cetera. So I think those are pretty straightforward. So then that brings us to the last substantive section, which begins on page 62. It's section 23. So it's about 30 pages of the bill. It has to do with credit for reinsurance, but a lot of it, I don't think the substantive provisions are that lengthy. So just to summarize, I think you'll remember a couple of years ago, 2-3 years ago, I can't remember now, you worked on legislation having to do with credit for reinsurance, specifically for foreign or alien reinsurers. So what this section of law has to do with is when a company can claim credit for any risks that it cedes to. So an insurance company can claim credit on its balance sheet for any risks that it cedes to a reinsurer. Historically, there used to be pretty strict collateral requirements that apply to non-US reinsurers. I think they had to have 100% security collateral in the United States. There were at least 1 or 2 international agreements that were entered into, and a subsequent proposal that some of those requirements would be not quite as stringent for particular jurisdictions. So maybe this is ringing some bells that you worked on this a couple
It's
years
not.
ago.
So.
It's not?
No.
Oh. But maybe that's a
It
good
may have
thing.
been when I was not here, but it is not ringing bells. And usually I get at least a slight tingle here. So.
Okay, so what I just provided there was meant to be a little bit of background about when you last looked at this statute and made some amendments to comply with federal law, basically. And the reason why I say that is because there's not a lot of discretion to the state in this instance. Basically under federal law, and I believe it was the Dodd-Frank Wall Street Reform Act, all states need to allow for these standards. And if you don't comply with the new requirements, basically you'll be preempted. So again, not a lot of discretion to the state. And what the amendments here do is basically bring Vermont into compliance with those federal requirements and the NAIC model law that reflects those federal requirements. And this is a little bit time sensitive. It's my understanding that Vermont must not only pass this particular piece of legislation, but adopt the rules that are authorized here by September of this year in order to comply with the requirements. So just for example, if you look on page 63 of the draft, you'll notice the new language pertains to rules and regulations. That is consistent with a couple of other provisions in here, again, authorizing the commissioner to adopt those rules. So substantively, in terms of other requirements.
Before we go forward,
Yes.
Dodd-Frank was ancient history. Are these new federal regulations, or are we just getting around to complying with Dodd-Frank?
So yep, Dodd-Frank, yes, you're right. That is an older federal law. And I think it was the process of NAIC coming up with the model laws that complied with the federal law.
Okay.
And then the individual states adopting state legislation that reflects the model law. And so that's what you worked on in, I think it was 2020. And then there were a few other things that had not been done then, but need to be done to be 100% in compliance with those requirements.
So this is a work in progress. NAIC developed a model law that would bring states into compliance with Dodd-Frank. This is our final, we hope, adjustment, adopting that law so that we are in compliance with all federal laws, all federal laws required by Dodd-Frank.
With respect to credit for reinsurance, yeah.
Okay,
And,
we can't play with them, change them, or it's all in that.
right.
We like that, it cuts down floor time.
Okay, and which, did I explain that? Yeah,
Okay, no, we're not voting this out today. Okay, so can you give us just quickly, just.
well,
what
yep,
are
so
we
the rulemaking was a big part of it, and those rules will be adopted. Once this is enacted, that process will be commenced if it hasn't already started, so. The other sections that are more substantive in nature, I believe had to do with, let's see, I'm just looking at, on page 67, there are requirements. So I'm looking under, so one, the assuming insurer shall submit to examination of its books and records by the commissioner and bear the expense of the examination. But then subdivision B, Roman numeral 1, credit for reinsurance shall not be granted under this subsection B unless the form of the trust and any amendments to the trust have been approved by, and then there's just the commissioners of the relevant jurisdiction. Most of this language here is related to that trust and making sure that it is in effect for as long as there might be outstanding obligations that are due under the reinsurance agreement. So just all designed to ensure the solvency of the ceding insurer and ultimately protecting consumers, making sure that the companies are adequately protected as their books reflect. So I don't know that there was any other major substantive provisions. You'll see on page 72, these are the surplus requirements. Again, all related to solvency and ensuring
So these are.
there's adequate
Dodd-Frank was
protection.
really set up as the result of the recession, but the major Wall Street collapses, bank collapses. And this is really looking at making sure that trusts are solvent. Is that?
I think that's right, although I'll let the department, they might be better able to explain the underlying purposes.
Yeah, the only thing I would add that to what Maria has said is I believe we have added some language around rule adoption for the commissioner. I think that was a component that was important for this particular statutory regime because we have to do rulemaking by September 2022 as part of this timeframe that we've been given. And one of the things that this provision of Dodd-Frank was trying to address was different treatment for reinsurance in different international jurisdictions. So I think one of the reasons it took so long to implement this portion of Dodd-Frank is that the US and the UK and European Union had to reach a covered agreement that would sort of have a uniformity in terms of how reinsurance could be credited to a balance sheet. And once that was reached in 2019, then the NAIC developed its model. And I believe the way Dodd-Frank works is it says once this covered agreement has been agreed to, if a state is not in compliance with it, then it's preempted by federal law. So the covered agreements are in place as of 2019. The model was created shortly thereafter. We implemented the model, but there's some rulemaking that we have to do as part of that also. This, I think the most important piece is that it gives us the authority to do that rulemaking and do it in a time frame by September of this year.
Okay, I think that's probably the question I'm most likely to get on the floor is, why are we doing Dodd-Frank now? But we've done most of it. This reinsurance section, because international companies had to come to an agreement, or nations had to agree.
Yeah.
That didn't happen quickly. They happened, then NAIC did the model law. The one thing that we are really, the commissioner needs some rulemaking authority to finish this up. And this should get us into compliance with the federal law. And if we don't do this, then the federal law is imposed anyway. Okay. Okay,
Madam Chair, can I ask a question?
yes.
The Commissioner, you said that you would do rulemaking by September. That seems really fast. You don't mean everything would be done by September, do you?
Yeah, I think we are lined up to have that rulemaking done by September. So this rulemaking itself is a model, so it doesn't take too much. It doesn't take too much for us to draft, but I do think we'll have enough time to hit all of the processes to do it through normal rulemaking and won't have to do emergency rulemaking. But I think the alternative potentially would be emergency, but we wouldn't want to do that, I don't believe.
Okay. And the dates, it seems like there's a bunch of dates that are changing, and then the amounts, like the amounts they have to have in trust or something, those are all, the dates work for you, even though they're, because it seems like there are a bunch of date changes in here.
Yeah, I mean, I think the dates and the amounts, they work for us to the degree that we have any discretion over, right? I mean, they are sort of what they are based on
okay.
the agreement.
So you have to make them work. I get it. Okay.
Okay. So that's 30 pages.
That is 30 pages, and that brings us up to the last page. The effective date section. So the act takes effect on passage, except for the sections that had to do with travel insurance, which take effect 90 days after enactment. So a little more time there. And that's everything.
I love that a lot of this is about capitalization. You made a lot of things lowercase, Maria.
Association, yes, I think, was that one of them?
We always
Yep.
do that. There's always a changing standard. Okay,
We've led council something to do in the summer.
that's right.
Oh,
All right, Senator Bray.
So, a question for maybe the commissioner, if we don't take this step on the Dodd-Frank related section, but it's imposed on us anyway, is there discretion in terms of how you implement? So you'd rather see us implementing our version of it than a standard version? Is that the thrust?
Yeah, I think that's right. I mean, I think for two reasons. One, there's NAIC accreditation implications. So the NAIC, accredits states, and when you're accredited, like our states that operate here, when we do examinations of them, other states can rely on our examinations because they say, we've gotten the good housekeeping seal of approval that we're up to date on all of our laws and regulations, and we have sufficient resources and the like. So it's important for that reason. And then I am a little rusty on the particulars of the credit for reinsurance, but if I remember correctly, the law would be preempted, which would be, and the standard that would apply would be harsher for companies than the one that is seeking passage here. So I think this is a more favorable standard all the way around for the industry. And that was sort of an incentive to get states to pass this model, was that the preemption would force something that was less was less helpful for no substantive reason to companies operating in your jurisdiction potentially. So I don't know if Dave or Kevin, Dave or Kevin remember more of those details. I haven't, once we passed it in 2020, I had it, I shelved a lot of it out of my brain. So I see Dave coming off mute.
Yeah, a lot of it's out of my brains as well, but for captives, the focus was, this is somewhat reciprocal international regulation and acceptance of companies that our captives deal with every day. A lot of our captive business is ceded to reinsurers overseas, particularly in Germany, France, the UK, but also in Bermuda and the Cayman Islands with affiliated reinsurers. So this all just helps keep that market open and functioning properly from our point of view.
So is it fair to say that it's both about compliance and also about keeping Vermont as a most attractive place because of our level of compliance and how up to date we are?
Yep, our accreditation is very key for all of our companies to be able to operate. So anything where we vary from accreditation standards is a competitive disadvantage, if you want to put it that way.
Yeah, sure. Thank you.
Okay, any other questions? Okay, thank you, everyone. We will be back once we've had time to read and digest all of this. I think it's probably a lot simpler than the volume of pages might suggest. And it'll just take a little while to get that all digested. So thank you. Thank you, Maria. We are finished for the day. We can go off live